You open your 401k app, it's an election year, and your stomach just drops. The balance is bouncing around, headlines are screaming, market chaos. Your uncle on Facebook is yelling that if his candidate loses, the market will crash, and you catch yourself hovering over that move to cash button thinking, maybe I should just sit this one out. Here's the thing, now if that's you, you're not weird. You're human, and historically, this exact moment is where a lot of people quietly destroy decades of future returns in a single emotional click. So in this video, I want to walk you through what actually happened to the stock market and to long-term investors during past US elections, how your brain is wired to overreact to political drama, and then we're going to build a simple, boring, election-proof playbook for your 401k. Stay invested, diversify, and stop pretending you can outsmart the next headline. Now look, I know what you might be thinking. Vit, this time is different. This candidate is crazy. Democracy is over. Surely this election will finally break the market. Here's what most people don't realize. If you zoom out on actual data, election years look a lot more boring than the news cycle wants you to believe. Let's start there. First, quick reality check on what's at stake for you personally. If you're an average US 401k saver, your balance is probably somewhere in the low six figures. Fidelity's latest numbers show the average 401k around $120,000 to $130,000 in recent years, with total savings rates, that's you plus your employer, climbing toward about 14 to 15% of your pay. That's real money. That's future use rent, healthcare, and groceries. So every time you let election drama push you into or out of the market, you're playing games with something that took years to build. Whether you have $5,000 or $500,000, the math of compounding works the exact same way. The percentages do not care about how many zeros you have. Now let's kill the biggest myth straight away. Elections always crash the market. When researchers looked all the way back to 1928 and pulled out every single presidential election year, 24 of them, the average S&P 500 return in those election years was about 11.6%. Over that same long history, the average for all years was about 10%. So on that data set, election years were not some disaster. They were actually slightly better on average. On another dataset that starts in the 1970s, election years came in around 8.7% average returns versus 7.7% in non-election years. Again, very similar, slightly higher. And a separate study that starts after World War II finds election year returns a bit lower than average, roughly 6.1% versus 8.8%. This is where it gets interesting. Depending on how you slice the data, election years are sometimes a little better, sometimes a little worse, but always in the same ballpark as normal years. In other words, if someone tells you election years are always great or election years are always terrible, they're selling a story, not reality. What about the really bad cases? Out of those 24 election years since 1928, the S&P 500 finished negative in only 4 of them. 1932, 1940, 2000, and 2008. Do those years ring a bell? 1932 was the depths of the Great Depression. 1940 was World War II risk. 2000 was the dot-com bust. And 2008 was the global financial crisis. These weren't, oh no, this candidate won crashes. These were massive economic and financial system problems that happened to overlap with elections. Here's what most people don't realize. The market doesn't move because of red versus blue on a campaign poster. It moves because of earnings, interest rates, credit conditions, and global shocks. Elections are just very loud background noise layered on top. But if we step even further back, across almost the entire modern history of the S&P 500, about 3 out of 4 years are up years, and the average annual total return has been around 11%. That's with wars, impeachments, recessions, booms, pandemics, and every flavor of political drama thrown in. The long-term trend is up and to the right because companies innovate, populations grow, and the economy compounds. And here's the punchline nobody wants to hear on cable news. Studies that slice the data by which party controls the White House or Congress find no statistically significant impact on U.S. equity markets over the last century. Markets have performed well under both parties and poorly under both parties, depending on global conditions. So if the big historical picture says election years are usually positive and politics doesn't reliably change the long-term returns, well, why does it feel so insanely stressful when you're looking at your 401k during an election? That's psychology. Your brain is not wired for long-term compounding. Your brain is wired for saber-toothed tiger is coming. React now. In an election year, you are bombarded with messages designed to keep you in a permanent fight-or-flight state. Every ad, every debate, every push notification is basically saying, if the other side wins, your way of life is over. Pair that with a red or green number next to your retirement balance, and suddenly a normal 5% market move feels like personal confirmation that the world is ending. Now you might be thinking, okay, but markets do get more volatile around big events, right? Yes, within the year, things can get choppy. Analyses of presidential cycles show that election and midterm periods often come with more day-to-day and month-to-month volatility, even when the full year ends up positive. One day, the market rallies because a poll looks favorable. The next day, it sells off because of a debate comment. But when you zoom out to a one-year or multi-year chart, the noise blurs into just another little wiggle in the long-term trend. A great example of how unpredictable this is, after Joe Biden's victory in 2020, the S&P 500 was up more than 40% in the following 12 months. After Jimmy Carter's win in the 1976 election, the S&P 500 was down around 6% over the next year. After Ronald Reagan's first win, it was basically flat, and after his re-election, it jumped almost 19%. Same system, different macro backdrop. Trying to trade based on my candidate lost, so the market will crash, would have been completely wrong many times in history. So mathematically, elections haven't been the doom event people fear. But behaviorally, elections are amazing at triggering bad investor behavior. During the 2020 pandemic shock, which hit in an election year, Vanguard studied millions of U.S. investors. Only a small subset panicked and moved their entire portfolio to cash between February and May. But here's the scary part. More than 80% of those cash panickers would have been better off if they had just done nothing and stayed invested through the volatility. The cost of reacting to fear was real, measurable money. Another analysis of retirement plan participants found that in 2020, about 12.8% of self-directed investors made changes to their portfolios, compared with only about 4 to 6% of people who were in professionally managed or default options like target date funds. The people who were in charge of their own mix were much more likely to tinker during stress, and tinkering often means buying high and selling low. And even outside crises, we see how powerful default behaviors are. In 2021, Fidelity found that when workers were automatically enrolled in their 401k, fewer than 1 in 10 opted out, and only around 6% of people actually cashed out when changing jobs. Most people, when left alone, do the right thing. They keep contributing, they don't yank their money out, and their balances grow. The danger is when we feel like I have to do something because the news is loud. So let's connect the math with the psychology using your 401k. Imagine you've got $120,000 in your 401k. That's not a fantasy number. That's right around the recent U.S. average balance. The market dips 15% in the months leading up to the election. On paper, you're down $18,000. That hurts. Your brain interprets that as, I just lost a used car. You're angry, scared, and a little ashamed. Here's what most people don't realize. At that exact moment, you haven't lost anything in a permanent sense. You own the same number of shares. The price those shares change hands at in the market is lower today, but unless you sell, the damage is temporary. If you continue to contribute every paycheck, you're actually buying more shares at a discount. Now let's add psychology. Your brain hates uncertainty more than it hates loss. It wants a story. Elections give you a perfect story. The market is down because of this candidate / this policy / this debate. If I just sit in cash until things are clear, I'll be safe. That feels rational, but it's actually your brain trying to reduce emotional discomfort, not increase expected returns. Let's run a very simplified example. Option A. You ride out an election year where the market ends up plus 6% for the full year. That's in line with some of the historical election year averages we just talked about. Your $120,000 goes to about $127,200 by year end, plus you've been adding contributions along the way. Option B, you panic when you're down 15%, sell to cash at $102,000 and wait for clarity. The market recovers into the election and ends the year up 6% from where it started. That means from the low to year end, the market is up roughly 24%, but you're sitting in cash the whole time. By sitting in cash for just those few months of recovery, your $102,000 stays $102,000, while the person who stayed in ends the year with around $127,000. That's roughly a $25,000 anxiety tax you just paid for reacting to headlines instead of following your plan. Is this oversimplified? Of course. But it captures the basic math of what Vanguard actually found in real accounts during 2020. The majority of people who panicked to cash would have had more money today if they'd done absolutely nothing. This is where it gets interesting, psychologically. From the outside, it's obvious that stay invested beats panic sell. But when it's wrapped in election chaos, your brain frames it differently. It tells you, I'm not panicking, I'm being responsible, I'm protecting my family from political risk. Same behavior, nicer story. So how do we de-weaponize election chaos for your 401k? Let's build a simple, realistic playbook. Step 1. Accept that elections are normal market events, not special disaster events. We've seen that over almost a century of data, election years don't consistently destroy returns. In some datasets, they're a bit lower than average. In others, they're a bit higher. In most, they're just normal. Out of 24 election years since 1928, only 4 were negative, and those lined up with some of the worst economic crises in history. That tells you the real risk driver is the economy, not the campaign. So instead of asking, who will win? Start asking what's my time horizon? If you're 35 and you're investing for age 65, that's 30 years. That's 7 or 8 presidents. No single 4-year term has ever defined the entire market path over 30 years. Step 2. Decide your 401k strategy outside of election season. Here's the thing. If you only think about your 401k when there's a crisis or an election, you are setting yourself up to make emotional decisions. Your asset allocation, how much you have in stocks versus bonds, US versus international, should be set based on your risk tolerance and timeline, not based on who's leading in the polls. One reason professionally managed options like target date funds saw fewer people making changes in 2020 is that the decision architecture was better. People weren't staring at a menu of 8 funds they felt responsible to shuffle around. They had one diversified fund handling it. You can recreate that for yourself by picking a diversified mix you mostly automate and only review on a schedule, not when Twitter is melting down. Step 3. Automate contributions and detach them from the headlines. The good news is, most US 401k savers already do this. Average total savings rates around 14.3% SATC, close to the commonly recommended 15%, and record numbers of people increasing contributions show that, in general, people are behaving well despite volatility. Auto-enrollment and default investments keep a lot of workers steadily buying through ups and downs. Don't break that system because of an election. Psychologically, you want to shift your identity from, I'm trying to guess what the market will do in November, to, I'm the kind of person who buys a little bit of the global economy every single paycheck for decades. The election will come and go. Your contributions will still be there, quietly compounding. Step 4, diversify so you're not hostage to one narrative. Election coverage loves to create sector winners and losers. If this candidate wins, clean energy is dead. Or if that candidate wins, defense stocks will explode. But when analysts actually looked at sector performance across multiple election years, there was no clean, consistent pattern of which sectors outperformed based on who won. It's messy. Sometimes defensive sectors do better because the macro backdrop is scary. Sometimes growth sectors lead because rates are low and earnings are strong. In your 401k, that argues for broad diversification. Total market or S&P 500 index funds, maybe an international fund, maybe some bonds as you get closer to retirement, rather than big bets based on political predictions. No one can reliably map campaign speeches to sector returns over a 10-year horizon. Step 5. Put guardrails around your own behavior. You know your triggers. If you're the kind of person who logs into your account every day and freaks out at red numbers, give yourself rules now. I only check my 401k balance once a quarter. I don't make allocation changes within 30 days of an election. I will not move to all cash based on headlines. If I feel the urge, I'll sleep on it for a week. It sounds silly, but remember, a small fraction of investors who broke their own discipline in 2020 paid a real price, while the majority who stayed the course came out fine, even after one of the wildest years in market history. And finally, step 6, zoom out and reframe what risk really is. Right now, you might see the risk as, what if the wrong candidate wins and my 401k drops 20%? But if you're investing for retirement 20 or 30 years from now, the bigger risk is actually the opposite. What if I let short-term fear push me out of the market and I miss decades of compounding? Historically, despite recessions, wars, and political chaos, staying invested in a diversified stock portfolio for long periods has rewarded patient investors. That doesn't mean straight lines up or no scary drawdowns. It means that the price of those long-term returns is enduring periods where everything feels like it's breaking. So when you're staring at your 401k during election chaos and your brain is screaming, do something, remember this. The data says elections are noisy, not fatal. The data says timing the market based on fear usually backfires. The data says people who quietly keep contributing and avoid panic decisions tend to end up with larger 401k balances over time. And the psychology says your brain will keep trying to convince you that this time is different, that you're being smart by waiting it out in cash until the coast is clear. Here's the thing. The coast is never cleared. There's always a crisis, always an election, always a headline. You don't need a crystal ball, you need a system. A system where your 401k contributions run on autopilot, your allocation is set by your long-term plan, you understand that volatility in election years is normal, and you measure your progress in decades, not news cycles. If you do that, then 4 years from now, 8 years from now, you'll look back at this election not as the moment I blew up my retirement because I got scared, but as just another crazy year where I stuck to the plan. And that's the quiet, boring way real wealth is built. So the next time you see election chaos on TV, I want you to glance at your 401k, take a breath, and say, okay, markets have survived worse. My plan is long-term, I'm staying invested, I'm diversified, and I'm not letting someone else's political story hijack my financial future. If you can internalize that story, your future self will thank you, no matter who wins the next election. Thanks for watching. If this video changed how you think about money, hit subscribe and share it with someone who needs to hear it. I'll see you in the next one.